Bismillahirrahmanirrahim. Assalamu alaikum. Welcome to today's video on principles of accounting. This is just will cover the basic things. Normally, it will help those I will say technical IT professionals, different other departments who don't know about accounting. So they will take help out of it. So they will be able to know, okay, what are the accounting terminologies, how to do debit and credit, things like that, right? It's not advanced, it's just for basic people. So just be with me for a few minutes. Okay, accounting. If you see, accounting is to provide information to the decision makers, and this will help them in making economic decisions, right? Okay, accounting will be answering questions, especially like how well did the organization performed, where does the organization stand, right? The accounts answer these questions with two major financial statements: income statement and balance sheet. So they will produce these two statements which will answer the above two questions. All right. Okay. Accounting basis. Accounting basis actually it's based on two bases. Accounting there are two accounting bases. One is accrual and one is cash. Let's take first accrual. Accrual is you will charge any expense in which it is occurred even if you haven't paid. So let's say, for example, your electricity bill, it will be paid on 15th of February, right? But January is already used. I mean, you have used the electricity during January. So one way is you don't charge this expense to January, but when you will charge that to be February, it will be doubled for the February. So on 30th, you will charge based on your assumptions for January, and then because you have to generate the reports or statements, so those should be realistic, right? Further, you can go through this text as well. It will be explaining the same. Okay, cash basis is when you paid cash, you will record that time or you will hit in that month. Normally periods are on monthly basis, let's say January, February, March. So if you are paying in February, even the bill is of January, you will take into account in the February, which is actually not a realistic, because that expenses of January, but you are charging in February. Okay, there are different financial reports, so these are very important, and based on this, your whole accounting will be there: balance sheet, income statement, owner's equity statement, cash flow statements. You can go into further details if you want to. Okay. Now there is a question. Let's say, for example, there are different reports, right? I just discussed. Let's say, for example, there are different companies, there are different finance people or accountants. So if they are preparing reports, there will be no standard, right? I mean, what they have to include, what they will not include, or how they will include, what will be the format. So it should be understandable to everyone across the board or outside your company. So for that, there is standards of generally accepted accounting principles, GAAP. This is normally called GAAP. So companies normally follow GAAP standards and produce their statements or whatever the information they have to share. Okay, next is accounting equation. These are the concepts. If you understand these concepts, then it will be very easy, right? Okay, if you want to check, if you have these three variables, right? Assets, liabilities, and owner's equity. So assets is equal to liabilities plus owner's equity. I will share in the next slide what is the asset or liability. Okay, assets, whatever company owns to run the business, right? Liabilities is the payments which they have to pay to suppliers or vendors, right? Those are liabilities. So, these are minus. Owner's equity. Owner's equity is what owners, oh sorry, my mouse is, this is owner share, right? So, if liability minus this, right, it should be your assets. So, if you know one of if you do not know one of them out of these three, you can find very easily, right? It is very easy, just mathematics. Like if you do not assets and owner's equity, then see like this, right? Okay. Now, what are the assets and liabilities? Any tangible, intangible resources, tangible which you can touch, intangible which you can't touch, right? Resources owned which can be used to do business, right? Tangibles like building, cash, bank balance, receivable, vehicles, plant and machinery, furniture, computers, etc., right? And intangible like goodwill, logo, because these things also have the value, right? Brand value, application like softwares or whatever, because you can use softwares but you can't touch them, right? Intangible. Liabilities legally payable to suppliers or vendors, whatever you have to pay to your suppliers or even banks, whatever, as a loan. So, those will be in under your liabilities. Okay, double entry. Double entry is always each transaction will have two sides, like I have shown. This is called T account. So, on left side it will be debit, on right side it will be credit, right. Next we will try to find what we have to put in debit or what is the credit or what are the rules, right. So, this is called T account. Okay, equity. Equity is after liabilities, paying liabilities, whatever is left, that is the equity. Owners, you can say, share or whatever you can say, remaining for the owners, right. Okay, like income normally will come, revenue will come into your business, and for expenses you have to withdraw or pay, so it will go out. So, here it is assets positive, liabilities negative. So, assets minus liabilities will be equity, like we have this equation before, we just studied 3. So, like for example, I just took one example here. Car price is 50,000 USD, just an exemption or sample values. You took loan from bank 40,000 minus, sorry, here it is loan, paid loan 20,000. So, still you have to pay 20,000 loan, right. So, 50,000 equity will be 50,000 minus 20,000 equals 30,000, right. Okay. Debit and credit rules. Now, these are important rules you have to keep in mind. Okay. Now, let us first discuss about the assets. So, if assets are increasing, then it will be debit. If assets are decreasing, you have to book them as a credit. So, let us say for example, you received cash. So, cash is your asset, it increased, right. Even if you received cash or it went to your bank account. So, bank account itself is also your asset, right. So, you are saying that okay, you received cash, that means cash increased, right. So, cash will be debit, the other account will be credit. I think for asset it will be clear now, and majority of transaction will have this one side as an asset, you are receiving or you are paying, things like that. Okay, liabilities. Now, if liability is increasing, it will be credit, increase is credit and decrease debit. Right. So, let us say for example, you have to pay to a supplier, you have purchased something from him, let us say 1000, right. So, liability is increased, right. So, it will be credit, right, by 1000. So, if you are paying him cash, right, so your liability will decrease, right. So, it will become debit. Since you are paying cash, so your cash is decreasing, right. So, it will become credit. So, debit, credit, right. I hope so it will be now easy. Okay. Owner's equity, same way, increase credit, decrease is debit. It is just like liability. Revenue, increase is credit and decrease is debit. Expenses, increase debit, decrease credit. This table you can just remember and you will be able to easily understand the entries. I put it like below, debit and credit is a plus and minus. So, you can even understand from this as well, right. So, where it is plus means increase, and if it is minus it is reduced, right. Okay. Revenue and expenses. The revenue is the price of goods sold and services rendered during a given accounting period. The revenue increases owner's equity and expenses decreases the same. So, rules for the revenue and expenses are extension of owner's equity. With increase in revenue, there will be increase in owner's equity, and increase in owner's equity is always credit. So, revenue will always be credited, right. Same way for expenses. Expenses are the cost of the goods and services used up in the process of earning revenue, because these expenses why you will do to make revenue. The increase in expenses decreases owner's equity, and decreases in owner's equity is always debit. So, expenses will always be debit if increased, right. Okay, few transactions just for to share the example. Let us say for example, you have a transaction paid cash. Now, you have paid cash, right. It can be through check as well. So, then it will be a bank account. 500 for telephone bill, right. So, here you are paying cash. So, cash is reduced, right. If cash reduced means credit. So, cash is credit. So, other is telephone bill, it is expense debit, right. Okay. Purchase furniture of rupees this on credit from Muhammad Hayat. So, let us say for example, this is you have not paid yet, right, it is on credit. So, there is a liability. If on it is credit, then means it is a liability, right. So, this is your supplier, like you are taking on loan, right. So, furniture is your asset, right. Increase in asset, debit, and this is supplier, increase in liability, credit, right. Here there are few entries, you can go through these. I do not need to go to each, because I gave you those principles or rules, you can just follow and try, right. You can stop your video here and you can just try and try to make debit and credit, right. Same, this is second page. Okay, there is another terminology in the companies. One is Capex and Opex. So, Capex is a capital expenditure used to purchase assets like property and equipment. Spend should be more than the current year. It should not be, let us say for example, within the year, right. So, a depreciation amount of each of each month will be charged till life of asset, except land as defined. So, normally you define, each company has a company policies, that let us say for example, you purchased an asset that is a laptop. If its life is 3 years or 4 years, so its price will be depreciated equally per month during this period, right. It is up to the company's policies. Another is Opex, operating expenditure, funds used to run day to day business, spend same year. These are the current year expenses. So, and also called as REVEX. If you, in few companies it is called as REVEX, revenue related expenses. REV for revenue and related expenses, right? Revenue expenditure. So you should be knowing now that what is Capex and what is Opex. Okay. I think I try to make it simple. You can go through this one, and hope it will help you to understand uh, basics, accounting basics. I will say you will be able to do debit and credit. You will understand, okay, what is the cash, what is supplier, what is customer. So I think it will help you. Further, you can share your feedback. Thank you. Allah Hafiz.